in my view, will motivate the Trump team, who are all rich people, not all, but most, to support the stock market. They will print money, but then the currency will go. So we will have a lot of volatility. And as I said, my view is you're not going to make money out of assets markets. I mean, not meaningful money. But I think gold and silver and platinum, those other commodities, the food commodities have started to wake up. I think we'll keep that purchasing power.
Marc Faber, publisher of the Gloom, Boom, and Doom report, believes the Trump administration will support the stock market through liquidity injections, potentially weakening the U.S. dollar and increasing volatility. He suggests that commodities like gold, silver, platinum, and agricultural products are better investments amid economic uncertainty. Since Trump's inauguration, the stock market has been relatively flat, with the S&P 500 opening at just under 6,000. Although there was initial growth after the election, the market faced resistance following the Fed's monetary tightening announcement planned for 2025. Investor concerns eased, leading to new highs by January 23rd. Additionally, China's announcement of the AI platform DeepSeek caused temporary volatility in the tech sector. Faber emphasizes that most people, including Wall Street, fail to understand inflation fully. He categorizes it into two key forms: consumer price inflation, which raises the cost of essentials like food, transportation, and insurance, and asset inflation, which drives up prices of stocks, real estate, and commodities. Recent economic data supports his perspective. In December, U.S. inflation saw its highest increase in 8 months, fueled by strong consumer spending on goods and services. This persistent inflation suggests that the Federal Reserve will unlikely cut interest rates soon. Given these factors, the performance of precious metals relative to equities remains a critical indicator. Aggressive price targets for gold and silver will only be attainable if more capital shifts from U.S. equities into safe haven assets. As market dynamics evolve, closely monitoring the interplay between inflation, Federal Reserve policy, and investor sentiment will be essential for navigating the financial landscape in 2025. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I never was, a big conspiracy theorist, but some of my friends who are very well informed, they have argued for the last 20 years that London doesn't have the gold it claims to have, and that there is a shortage, as well as for silver, and most likely for platinum as well. And we know that in the last 20, 30 years, the financial markets have grown like this, exponentially. The global economy has grown like this. So the financial markets are much bigger than the global economy nowadays. We can measure that by measuring the market capitalization as a percent of GDP. So when I started to work in 1970, the US stock market capitalization as a percentage of GDP was 25%. Now it's close to 200%. When it was 25%, when the stock market went down or up, it had no impact on the economy.
Right.
It had a little impact, but not a huge impact. Now, in my view, if the markets go down, they'll have a huge impact on the economy. Huge. In my view, will motivate the Trump team, who are all rich people, not all, but most, to support the stock market, print money, but then the currency will go. So we will have a lot of volatility. And as I said, my view is you're not going to make money out of assets markets. I mean, not meaningful money. But I think gold and silver and platinum and those other commodities, the food commodities have started to wake up. I think we'll keep that purchasing power. Basically, my view is that Wall Street doesn't want to, and the public doesn't understand really what inflation means and what it is. And in my view, there are two major categories of inflation, or the symptoms of inflation. Inflation is an increase in the quantity of money and of fiscal deficits and so forth. But the principal symptoms are either you have very high consumer price inflation. In other words, the price in your supermarket goes up,
Mm-hmm.
or the price of services go up. Like if you want to take a train or you pay for a taxi, the prices of these things go up a lot. Or insurance premiums is a typical consumer price inflation symptoms. Or we have other categories like asset inflation. When stocks go up, properties go up, and commodities go up, or house prices go up, and so forth. So these two major categories we have to treat differently. And this is one of the viciousness of inflation, that in the system, when you print money, the money doesn't flow evenly to everybody. To the banking sector first, and from the banking and insurance sector, it flows on into other sectors of the economy. You print money, and the money doesn't boost the asset prices that you would like to boost. In other words, the money could go into, say, coffee or cocoa, like in the last 2 years, or precious metals, or it went in the past into stocks. But as we print money, we don't know for sure whether Nvidia and Tesla will go up, because the money could flow into other sectors of the market.
President Donald Trump has announced new tariffs on imported goods, imposing a 25% tariff on most products from Mexico and Canada, with energy products from Canada facing a reduced 10% tariff, and an additional 10% tariff on all goods from China. According to the White House, these tariffs are set to take effect on February 4th and aim to advance U.S. priorities on immigration and drug trafficking. However, no clear conditions for lifting these tariffs have been provided, and with no compromise in sight, the U.S. appears determined to move forward. At the same time, affected nations seem prepared to retaliate. These tariffs introduce considerable uncertainty into economic and market forecasts. Initially, analysts believed that substantial tariffs on Canada and Mexico were unlikely due to their potential negative impact on North American growth. However, a sharp tariff increase on Chinese imports, ranging from 20% to 50%, was anticipated and factored into inflation projections. Marc Faber views tariffs as an unfair tax, citing 19th century England, where tariffs were abolished due to their economic harm. He warns that tariffs raise consumer prices, disproportionately affecting lower-income Americans. Let's get back to the interview.
Well, I have to give you the background. I would have voted for Mr. Trump in 2016, and I would have voted for him now, because both the candidates in the opposition, Ms. Clinton and now Ms. Kamala Harris, in my opinion, are horrible people, horrible. So anything better than these people is, let's say, an improvement. However, the problem with Mr. Trump is he's an arrogant, no-knowledge person. He takes decisions without having thinking through the process of the consequences of his decisions very carefully. He's very impulsive, and he changes his mind, and he's an interventionist. Sadly, he thinks he knows everything better than anyone. So the tariffs, by and large, are a horrible idea. Horrible idea. The tariff is a tax, and it's an unfair tax. The economists in the 19th century already discovered that it's an unfair tax. So they removed the tariffs in England, which were the Navigation Acts and the Corn Laws, and thousands of import duties on everything. I wrote a thesis about that. That's why I'm interested. And I studied under a character called Heinz Haller. He supplied the economic academic background to the value-added tax in Germany, which was introduced by the finance minister Erhard. The book is not in a good condition because I kept it in a cellar, and my house was flooded.
Wow.
But this is the Bible about taxation. And I want to tell you, in taxation, and this was observed by several economists also in Sweden, you have to be very, very careful how to handle it. Because if you impose, say, a sales tax on someone, he may not be the one who pays for it. And
Correct.
the tax will be on the lower classes in America. That I guarantee you. everything will become more expensive as a result of tariffs. Now, he may not introduce them because soon he will notice that America may need China more than China needs America. And
Yeah, didn't
the
China
East Coast,
retaliate?
they may not. Maybe the tariffs do not interest them very much because what Mr. Trump doesn't know or forgets, at least half of exports from China to America are actually American companies that make goods in China. So, I mean, if General Motors produces auto parts or imports auto parts and there are tariffs on these auto parts, then of course the car in America will become more expensive.
Gold's relentless ascent and silver's steady resilience paint a compelling picture of the evolving precious metals landscape. The demand for these assets remains strong as global markets navigate shifting economic policies and fluctuating currency values. While gold continues to break new ground, silver's historical trends suggest it may have significant room to rise. With both metals at critical junctures, the question remains, will silver finally close the gap and reclaim its historic highs, or will gold's momentum continue to dominate investor sentiment? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.